Well, welcome back to You Heard from CFP. My name is Matthew Coyle. Today is September 29th, 2021. Where does the time go? Fall is flying by already. Let's talk about investment rate of return today. That's the topic on You Heard from CFP today. We're going to talk about what kind of investment rate of return should you expect on your money, depending on what kind of investor you are, and how long and when you invest. So it's an interesting topic. Let's dive in. Well, the purpose of this video today is not just to talk about investment rate of return, but also to motivate you, especially if you're a younger investor, as to what might be possible with a relatively small amount of money per year over a lengthy period of time and historically accurate rate of return. So let's take a look at what the market has actually done over the past, let's say, 45 years, from 1975 to 2020, and determine, what could you expect, or what is a reasonable rate of return to expect in a portfolio over the long term, given some historical assumptions. So I will put a couple things up on the screen here and we'll look at it from here. All right, so if you were a very conservative investor or a very aggressive investor, what historically would you have been able to expect given those two strategies? Because some people are usually somewhere in the middle. They're not 100% fixed income, or bonds are not 100% equity most of the time. They're somewhere in the middle. So what I'll do for this is just establish kind of an upper and lower bound and show you what historically a very conservative investment would have yielded and a very aggressive investment would have yielded. So if you were a very conservative investor, just purely investing in government bonds, and when I say government bonds, I'm referring to 10-year government treasury bonds, because that is often the most quoted instrument out there. It's probably the most common when they say government bonds, they're referring to 10-year treasuries. A government bond, and I'll put this up on the screen here, from 1975 to 2020, if you just put $5,000 in, you reinvested the proceeds, you didn't do anything else, but just let the money accumulate, your rate of return would have been about 6%, 6.11 to be precise. Then again, that's just $5,000 at the beginning of every year. You buy a 10-year government bond or theoretically a cost-free index that invests in that, and you reinvest the proceeds, and that's it. You would have had a 6.11% return. What does that mean on a dollar basis? Well, it means 45 years of that at 6.11% per year, $5,000 per period. You have a balance at the end of that time of 1.17, roughly, 1.17 million. Not a bad outcome. Anybody could certainly live on that. That's not a problem, but you certainly could have done much better if you were more aggressive. Now, if you were a more aggressive investor, what would that have net of you? So you could have certainly put that money into a 100% equity fund through the S&P 500, and there's lots of them out there to invest in. 1975 through 2020, what would that approach have netted you? Well, that approach would have netted you, reinvesting your dividends, roughly about 11.51% or 11.5% on an annualized basis as on an actual return. So $5,000 at the beginning of every year, starting with nothing, 11.5% would have yielded you roughly 6.47 million. So we have a bit of an upper bound and a lower bound when it comes to this. Not everyone's going to be 100% equity all the time, and not everyone is going to be 100% bonds or fixed income all the time. So it's safe to say that an upper and lower bound is somewhere between 5 or 6% on the low end, up to 11 or 12% on the upper end, as a reasonable rate of return given a conservative or very aggressive, historically aggressive strategy. So if a conservative lower bound is roughly 5 to 6, maybe 6.5% conservatively, and a aggressive upper bound is, let's say, 11 to 12, maybe 12.5% long term, depending on what index you're invested in or what fees are associated. What does that mean for your money, and how should you be allocating your money long term? Well, it really depends on the plan and how you work with your advisor to achieve that. Any advisor should be walking you through what they call a Monte Carlo test, a stress test on your finances, based on how much money you're putting in. What are your goals? What do you want to spend? Do you need 6%? Do you need 7%? Do you need 8%? Or are you okay with 5%? And you don't have to take as much risk. You don't really know that without going through the exercise of a financial plan or sitting down with a planner in general. So I will leave that message with this video on that particular topic. If you've not sat down with a planner, please reach out. We're happy to help you. If you've never done that, or if you work with an advisor already, they should be walking you through that process of showing you exactly what rate of return you need and what degree of confidence you have in those particular numbers. We do that with our clients all the time. It looks like this. I'll put it up on the screen. Referred to as a Monte Carlo test, a stress test. But at the end of the day, whether it's a 60-40 allocation, a 70-30, an 80-20, or even 100% stock, which frankly I don't think anyone should be in, but That depends on the plan. Work with your advisor, get to know the plan that you want to outline for yourself, and then have a degree of confidence behind that. Thanks for watching. I will see you next time, and thanks again. Bye.